Welcome to another webinar from the Peterson Institute for International Economics. And you've tuned into a very interesting one, namely two analytical chapters from the IMF's current World Economic Outlook being published this week. We're going to hear a presentation on chapters 2 and 3, which address really interesting and important issues and difficult issues of the current macroeconomic moment. Namely, why is the neutral rate of interest, why has it moved so low, and is it going to stay low or is it going to move up? That's the first question. And the second question is related, for obvious reasons. How about countries with high debt to GDP ratios? What are the conditions under which those debt ratios can be brought down, looking at historical experience? The World Economic Outlook team at the fund have prepared two very interesting chapters on this, and we have two presenters. Jean-Marc Natal will present the first paper on the interest rates. Jean-Marc is Deputy Chief of the World Economic Studies Division in the Research Department of the IMF. He's been at the fund for about, I guess, 12 years. Before that, he was at the Swiss National Bank for more than a decade. His PhD is from the Graduate Institute in Geneva. After him, we'll have Prachi Mishra to speak on chapter 3 on the debt ratios. Her PhD is from Columbia, and she is the she's an advisor to the fund, the chief of the Strategic Issues Division in the Research Department. She's been in that position since 2020. She has a number of other very interesting career, spent time at Goldman Sachs, the Reserve Bank of India. She was head of the strategic research unit there. She'd been a senior economist in the office of the chief economic advisor in the India's Ministry of Finance and the Prime Minister's Economic Advisory Council. So both very experienced and expert presenters. And we have two discussants, two Peterson fellows, Joe Gagnon. Joe has been at Peterson since, I guess, 2009 or so. And he came to the Peterson from the Board of Governors of the Federal Reserve System. And our second discussant, Olivier Blanchard, well known to fund followers, formerly the economic counselor, or commonly known as chief economist of the fund, up until 2015 when he joined Peterson. And before that, of course, a professor at MIT and the author of many important papers and books. So that's our lineup for today. So without further ado, I'd like to turn to Jean-Marc and ask him to tell us about interest rates.
Thank you very, very much, Patrick. Let me first thank the Peterson Institute for hosting the event, and in particular our discussant. We're really looking forward to their comments. So let me share my screen. Okay, so chapter 2 of the World Economic Outlook is dedicated this time to the natural interest rate, or in other words, the real interest rate that balances desired saving and investment and is consistent with output at potential and inflation at target. So it's neither stimulatory nor contractionary. The natural rate obviously is a key reference level for monetary policy, but it's also the anchor for real interest rate in the long term. And as such, it's an important input for assessing that sustainability. The study, of course, of the natural rate is not a new topic. Our discussants have themselves written a lot about it. But recent surges in inflation and public debt that followed the pandemic has brought the topic back in focus. So let me start with two, well-known pictures for context. They show that the real interest rate at all maturities and in all advanced economies have been declining for almost half a century. And because this happened when inflation was either declining or stable, this points to structural and common factors that drove the natural rate down. So more recently, you can see on the chart, real interest rates have increased sharply Central banks have tightened monetary policy following the rise in inflation. And now whether real interest rate will converge back to pre-pandemic levels when inflation is brought back under control, or whether the anchor has shifted, is very important for both monetary and fiscal policy. So in this chapter, we basically raise three sets of questions. First, we ask how the natural rate has evolved in the past, using various methodology to estimate the level. And we then go one level deeper and try to identify the main primitive forces that have driven this evolution, both in advanced and emerging market economies. The answer to this latter question is important, as obviously future natural interest rate will depend on the evolution of this driver, as we will show at the end of the presentation. So the main challenge for policymakers is that natural rate is not observable, and estimation are typically uncertain. So, to mitigate this issue, we follow a dual approach in the chapter. In the first step, we let the data speak as much as possible, and we use filtering approach. But unfortunately, as you can see from the large confidence band on the chart on the left, data do not speak very loudly. So the model is too simple also to pin down the real primitive driver of the natural rate. So we complement this analysis with a much richer theoretical model, which allows most potential drivers, such as demographic forces, productivity, fiscal policy, markups, inequality, or even international spillovers, to operate in the same consistent, coherent framework. The two approaches are obviously very different. When you can see on the left-hand side that they reach broadly similar conclusions, and they both point to a decline in natural rate in advanced economy of about 2 percentage points on average over the period. So, as mentioned before, using a theoretical model allows to basically look under the hood and to identify the main drivers of the natural rate. And the figure shows on the left-hand side here their respective impact for the last 40 years in 8 major advanced and emerging economies. And this set of countries represent about 70% of the global economy. So three points to note from the charts. First, as you can see clearly from the bars, aging population and slower productivity growth, which are the blue and red bar in the figure, can explain most of the synchronized decline in natural rate, and especially in France, Germany, and Japan, as you can see there. International spillover have been important, but on balance in this period, have played a more limited role due to offsetting effects. Second, the figure shows that the picture is more mixed in emerging markets. The natural rate has been basically constant in China, where an increase in TFP growth and fiscal policy have offset the impact of demographics. The natural rate has even increased in India over the periods. So third point from these charts is that fiscal policy, which is the yellow bar on the chart, has pushed up the natural rate in most countries over the period. And this is especially the case in Japan and Brazil, largest yellow bars. There are other factors such as rising inequality or increase in markup that are also taken into account in the simulation, but they have played a more minor role in our simulation. So turning to the future, we use the same framework to project the natural rate under a set of conservative assumptions for the 3 main drivers that we identified. So demographic forces, they are calibrated based on the UN long-term projections. TFP growth in emerging market is expected to converge to advanced economy by 2050. And debt ratio in the simulation are expected to follow IMF projections. So under this baseline assumption, natural rate, as you see, are expected to remain in a narrow range around 0 in advanced economies, but to gradually converge from above in emerging markets, in Brazil, China, and India. But that's the baseline. And of course, the projection is as good as the projection of the main drivers. Therefore, the chapter explores three plausible at this juncture alternative scenarios. First, the large government support during the pandemic may be difficult to withdraw. So this would raise the natural rate if public debt continues to increase and is perceived as less safe and liquid. So that's the so-called convenience yield. So we expect here that convenience yield will drop. Second, transitioning to a greener economy may also affect the natural rate. And here, the effect is more ambiguous and depend on how the transition is financed. In the case of budget neutrality, which is shown in the figure, the natural rate will drop as higher energy costs bring down the marginal productivity of capital and investment demand. But if the transition implies large public investment financed through public debt, then the natural rate could rise. It's not shown here, but box 2.2 in the chapter looks basically at both scenarios. Finally, a third plausible scenario in the current juncture is that deglobalization trends could intensify, leading to both trade and financial fragmentation. And in this case, our simulations show that the natural rate could increase in the US bloc and decline in China bloc as trade barriers lead to lower investment and capital flows become more regionalized. Individually, we expect these scenarios to have only limited effect on the natural rate, which are here ranging from -0.6 to +0.6 percentage points in the long run. But of course, in combination, the impact will be more significant. So let me conclude, given time constraints, with the main takeaway and policy implication of the chapter. First, our baseline projection suggests that real interest rates are likely to converge back towards pre-pandemic level once inflation is brought under control, obviously. But how close could depend, among other things, on the level and persistence of public debt, on how climate policies are financed, and on the extent of deglobalization. For monetary policy, this implies that the effective lower bound may be binding again in the medium term, which would complicate the work of central banks. And while low natural rate might be interpreted as a positive for debt sustainability, there are two important aspects I think that need to be kept in mind. Number one, many of the factors that keep the natural rate down will also affect potential growth with little benefit on debt sustainability. And number two, interest rates are endogenous to the level of debt, limiting the size of primary deficits that can be run in the long run. So our simulations suggest that long-term debt sustainability require a sizable deficit reduction in all the 8 countries that we follow in our sample, and delaying too much increase the necessary effort as higher debt tends to increase the cost of debt eventually. So I'll stop here and hand over to Prachi.
Thank you very much, Jean-Marc. That's fascinating. When everybody thinks, well, you were all wrong about interest rates falling, then now they're rising. So this is an important corrective to that, if you are right. But on to the consequences for debt, or the consequences of many other things for debt. Prachi.
Let me share my screen. I think Jean-Marc has to, yeah. Let me make it full screen. Can everyone see? Patrick, can you see?
Yes, it's good.
So good morning, everyone. Thanks a lot to Peterson for the opportunity to launch Chapter 3 of the World Economic Outlook. And thanks in advance to our discussants. The chapter is titled Coming Down to Earth, How to Tackle Soaring Public Debt. The chapter is co-led by my colleague Adrian Peralta and myself, and is the result of a huge team effort at the IMF. So this chapter is really motivated by the fact that public debt to GDP shot up during COVID-19 and is expected to remain quite elevated. So the black line, if you look at the black line in the graph, shows that globally debt to GDP, public debt to GDP remains quite high. If you look at the United States, which is the dark blue line, or China, which is the red line, they're expected to increase aggressively. But even if you look at advanced economies, excluding the United States, or emerging markets, excluding China, low-income countries, they are all projected to remain high. And this has been a big concern for policymakers, especially with the tightening financial conditions, weak growth, as well as a strong dollar. So against this backdrop, this chapter considers how to durably reduce public debt to GDP. And specifically, we ask 3 questions in the chapter. First, how have countries reduced public debt ratios historically? Second, how effective are different approaches to durably reduce debt ratios? Here, the chapter is really going to focus on fiscal consolidation and debt restructuring. And debt restructuring is broadly defined as a situation where a country under debt distress renegotiates terms of servicing existing debt with creditors. Let me say that while a vast literature studies the effects of fiscal consolidation on GDP, but far less work has been done on understanding the impact of fiscal policies on debt ratios. And since fiscal consolidation can be expected to reduce both debt, which is the numerator, as well as GDP, which is the denominator, at least in the short term, the net effect of fiscal policies on debt ratios is far from obvious. And finally, the chapter will also consider what are the implications for countries dealing with high debt today. Let me, in the interest of time, report the key takeaways, and I'm going to focus on the second bullet here. So what we find is that fiscal consolidation, when adequately tailored, can reduce debt to GDP ratios over a 1 to 5 year horizon. And what do we really mean by adequately tailored? 3 things. These are consolidations which A, are done during good times, for example, during domestic and global recoveries and when uncertainty is low. B, when initial debt is high or private credit is low. And C, it's more expenditure rather than revenue based, and this is a result only for advanced economies. Coming to debt restructuring, our main finding is that the impact of debt restructuring on debt ratios is sizable, and most importantly and surprisingly long-lasting. Moreover, it's most effective when A, it's executed through face value reduction or so-called nominal haircut, rather than through changes in maturity or coupon adjustments. B, it involves official creditors, and especially if it's part of a coordinated and large-scale initiatives for debt reductions. And C, regardless of how it's done, it's deep enough, and it's implemented along with a comprehensive set of policies, including growth-friendly fiscal consolidation. So with this introduction, let me start with the broad drivers of debt reduction, and then we'll focus on the impact of fiscal consolidation. So this chart depicts the results of a standard debt decomposition analysis, focusing only on historical debt reduction episodes. And let me just highlight quickly two key results. First, during debt reduction episodes, if you look at advanced economies, on average, debt to GDP ratio was reduced by 3 percentage points. And as you can see, the red bar, this is primarily driven by primary balance surpluses. If you look at emerging markets and low-income countries, reductions are much higher, 5 and 10 percentage points per year on average. And here, as you can see, the blue bars, which is real growth and inflation, play a much more significant role in EMs and LICs than they do in advanced economies. Next, what we do is in the chapters to characterize the features that increase the likelihood for fiscal consolidation to reduce debt to GDP. And here, if you look at the panel on the left, this reports from raw data the likelihood that primary balance improves and debt to GDP ratio falls, what we call in the chapter the likelihood of a successful consolidation. And on average, as you can see, this probability is about half. So periods of primary balance improvements are as likely to be associated with debt ratio reductions as they are with increases. So this chapter performs a range of econometric analysis and finds that the average fiscal consolidation, in fact, has negligible effects on debt ratios. So therefore, what we do is use a structural VAR approach to identify and characterize consolidations that do reduce debt to GDP. And this table on the right shows these identification restrictions. So following past work, we separate growth shocks from primary balance shocks. But what makes this analysis unique is we split the primary balance shocks into successful shocks, or those that can reduce, those where debt to GDP declines, and the unsuccessful ones where debt to GDP increases. So this slide reports the impulse responses to a 1 percentage point of GDP primary balance consolidation shock. And for illustration, we are showing only the advanced economies here. If you look at the blue line, basically these are impulse responses to the successful consolidation shocks, those that succeed in reducing debt ratios, whereas the red responses to shocks that do not succeed in reducing debt ratios. And very quickly, just to highlight one key finding, as you can expect, the decline in growth is much lower in consolidations that lead to a reduction in debt to GDP ratios compared to those that result in an increase in debt ratios. But it's important to point out, and something which is not obvious is that, and can be seen by comparing the responses of GDP and debt to GDP, is that the difference between successful and unsuccessful consolidation is in fact primarily driven by movements in debt than by movements in GDP. So one question you might ask is, why can fiscal consolidation fail to reduce debt to GDP ratios over and above its effect on GDP? And actually what happens is, in practice, countries often do things that offset the impact of fiscal consolidation on debt, for example, through so-called below-the-line operations. And as we dig into the IMF staff reports, it tends to happen all the time. For example, transfers to SOEs in Mexico, or clearance of arrears in the case of Greece. So what the relevant question for us is, what actually might increase the likelihood that fiscal consolidation reduces debt ratios? And to answer this question, we employ a panel of country years with successful consolidation shocks, and the probability of success is regressed against predetermined economic conditions. And what we find is that the likelihood of success of fiscal consolidation and reducing debt ratios is in fact higher during good times. These are the blue bars, that is when during domestic and global recoveries and when uncertainty is low. Second, when initial public debt is high or when private credit is low, indicating high initial crowding out effects of public debt. These are the red bars. On the magnitudes, let me quickly say that the chances of durably reducing debt ratios can go up from the baseline of about half to more than 3/4 if conducted during good times, which is adding the magnitudes of these 3 bars. We now turn to another way of reducing public debt, which is to engage in restructuring with creditors. And specifically, we ask in the chapter, how effective are restructurings in reducing debt and under what conditions? And one stylized fact is that restructurings actually happen rarely in advanced economies. We only have 3 restructuring events in the sample period over 1950 to 2021. This slide basically reports some of the key stylized facts on restructurings in EMs and LICs, where most of these happen. And in summary, if you look at these blue parts of the pie charts, you can see that debt restructuring is mainly done through reprofiling, or in other words, maturity extension or coupon reduction, rather than nominal haircuts. It's mostly done preemptively, that is before missing a payment and with official creditors. So what we do next is an econometric analysis to estimate the effects of restructuring on debt to GDP, and the results are reported on this slide. The average impact of restructuring on debt to GDP is negative, but importantly also statistically significant, and as I said, surprisingly long-lasting, reducing debt to GDP by an average of about 8 percentage points after 5 years. The impact is also higher, as you can see from the red bars, when in fact debt restructuring is combined with fiscal consolidation. Finally, the chapter also draws on the unique vantage point of the IMF to derive granular policy lessons from the experience of countries that actually went through restructuring. And we consider 5 cases which are summarized in this graph based on inputs of various IMF staff. And this chart shows the cumulative debt decomposition during the relative periods. And let me just highlight 2 cases. Seychelles is a prominent example of a successful debt reduction episode. As you can see from the black square here, public debt declined sharply by more than 100 percentage points of GDP and in a very short period of time. Restructuring through nominal haircut, which is the green bar, contributed significantly, about 1/4. At the same time, fiscal consolidation and growth were also dominant drivers of the observed reduction in public debt ratio in Seychelles. Belize, on the other hand, which you see here, is a case where public debt to GDP actually remained elevated despite two sequential restructurings. And this was even when restructuring in Belize was done early before missing payments. And restructuring in Belize was actually executed through coupon reduction and maturity extension. But importantly, the resulting debt service relief from restructuring was not saved. So the absence of fiscal consolidation, or the absence of the red bar, which you saw in the case of Seychelles, contributed to the increase in public debt. So the case of Belize basically suggests that even when done early, if it's not deep enough, and if it's not combined with fiscal consolidation, debt could in fact remain quite elevated. Bottom line from the case studies is really took an all-out approach with a comprehensive set of policies and bold actions for substantial and durable reduction in debt ratios, as you can clearly see from Seychelles' case, that with all the bars lining up in the same direction downwards. With this, let me conclude with policy recommendations from the chapter, and let me highlight three very quickly. First, if you're really a country aiming for a moderate and gradual reduction in debt ratios, growth-friendly fiscal consolidation is recommended, especially when revenue recoveries continue or in the presence of favorable external conditions. However, if you are a country facing increased funding pressures or already in debt distress, you might have no viable alternative than a substantial or rapid debt reduction. And for these countries, bold policy actions would be needed, which includes timely debt restructuring, but also combined with fiscal consolidation and growth-enhancing policies. And finally, I think reducing debt ratios durably ultimately hinges on strong institutional frameworks to, number one, to ensure that good times actually translate into debt reductions. Number two, for buffer building, and number three, to prevent the below the line operations that undermine debt reduction efforts. With this, let me stop and look forward to the discussion. Thank you very much.
Thank you very much, Prachi. It's very striking how many attempts to restructure debt, even with increases in primary surplus or reductions in primary deficit, don't work, and even when there's a debt restructuring, that was very striking to me from that. And before I turn to our discussants, I want to remind the very large number of people participating in this to prepare your questions and put them in the Q&A, because we'll have time for Q&A after the discussant's presentation. So use the Q&A, but don't use the chat, use the Q&A. First discussant, Joe Gagnon.
Thank you, Patrick. And it's a pleasure to discuss this very important set of chapters. I'm going to focus my comments on chapter 2, and I believe Olivier will be focusing more on chapter 3. So I'd like to just preface my remarks with one thing. The chapter is focused on the natural rate of interest. It's the real rate of interest, which is a concept that economists are very familiar with, but might bear mentioning for some of our listeners that it's not quite what we think of, what many people think of when they look at interest rates. So the real rate of interest is the nominal rate of interest minus the expected inflation rate, and the nominal rate of interest being the rate of interest you'd get if you put your money in a 12-month bank certificate of deposit. The bank tells you what the interest rate is. That's the nominal rate of interest. Then the real rate of interest is that 12-month interest rate minus the inflation that you expect to happen over the next 12 months. So 1 year ahead inflation expectations. And that's because if you get 5% interest and if prices stay the same, then you can buy 5% more goods and services in a year's time. But on the other hand, if inflation goes up 10% over that 12 months, you're actually going to be able to buy 5% less. So, and that's a negative real rate of interest. So we tend to assume, it's well known that if inflation surprises on the upside, so you get more inflation you expect, that's a negative for the real rate of interest ex post. And we've seen a lot of that lately. But economists tend to assume that, well, if you expected the inflation, then you're going to demand a higher interest rate, and so the real rate won't change much. I actually think perhaps we assume that too easily, and I'm going to come back to that. The chapter convincingly shows, and what other research has also been showing in the past 5 or 10 years, that the trend real rates of interest have fallen across the advanced economies for some decades now. This is less clear in the emerging and developing economies, and I'm not going to focus on that so much, and neither does the chapter. But I would note that one reason I believe why that's true is that many emerging and developing economies had relatively large inflationary episodes that pulled down the real rate of interest even in the past, and so the trend over time is less obvious. Now, the paper goes on to talk about simple techniques, and I guess Jean-Marc didn't really discuss this too much in his talk. There's a simple statistical technique proposed by Holston, Laubach, and Williams to make some very strong, simple assumptions and sort of relates real rates of interest to growth and other factors. And this is a good first cut, but it actually makes such strong assumptions, including that all sources of growth affect interest rates equally and that other factors really aren't explained or broken out. And you might expect that a large shock like COVID, where the underlying factors are moving differently from history, would cause problems. And indeed, the paper chapter shows a graph that indeed that is the case, that COVID is a conundrum in these simple models. So then the chapter moves on, and this is what Jean-Marc did focus on with a model by Platzer and Perufo, who break different sources of growth down and look at other factors like longevity, inequality, fiscal policy, capital flows. And I think these are the right things to look at. However, and it's very helpful, however, the results are all shown based on calibrated assumptions about how these various factors affect interest rates. And so it is dependent on what those values are. I didn't have time to go into the whole literature on this, but Olivier helpfully shared with me a new paper by Freddie Halen and some co-authors at Ghent University, which is one new study that looks at basically most of the same factors that Platzer and Perufo look at, but do an empirical regression just to say what they do. And some of the results are similar, but a couple are different. And not to say which is right, but it does give you a flavor of, well, how certain can we be of these results? A different calibration could yield different results. In particular, this new paper by Halen et al. Finds that technological-based growth, increases in the total factor productivity of the economy, actually have little effect on the real rate of interest, whereas the calibration in this chapter assumes it has a big effect. So that's something to think about. And then this also paper finds that inflation can have a big negative effect on the real rate of interest, which the chapter doesn't really allow for. And this is not just a surprise effect, because they find this effect lingers even after up to 5 years, which reminds me of the sort of emerging market episodes in the past. Of course, in the advanced economies that this new paper looks at, there weren't big inflationary episodes, but perhaps if there had been, it would have had similar results. Anyway, it does raise a question of whether we should be looking at a short-term real rate as a measure of monetary policy or not. The chapter implicitly does that at one point, and some people have mentioned that. But I do wonder, I mean, if you think about last year, in the end of 2022, in the fourth quarter, after a series of extraordinary rate hikes, the Fed had raised rates 400 basis points. That's a big tightening, 4 percentage point raise in the policy rate. However, expected inflation one year had also rose by about as much, to 5.5%, so that the real short-term rate in the fourth quarter of last year was still negative 1.5. It hadn't changed over the year. So do we take from that in fact there was no tightening of monetary policy? Some people have said that. I don't think so. So it does make me worry that this assumption that expected inflation, real rates based on expected inflation are what matters here is perhaps a bit too strong. In terms of the conclusions, I was struck by different scenarios didn't have very big effects on the projected real natural rates. And so I think I'd like to do a little more digging. The convenience yield is, if the paper talks about the, if we have bigger deficits going forward and bigger pileup of debt, that could raise the natural rate. I think that's right. I do wonder whether that would be entirely through the convenience yield, as the paper argues. That's basically the spread between government yields and other yields. Would that be the main channel by which that would go up? My understanding of the earlier literature on this was that there might actually be effects on all yields. Private borrowers might have to pay more if government debt is higher. At least that was my understanding of the earlier literature. The paper doesn't really go into that. But it seems to me that it's possible that climate transition, maybe the need for more defense spending, things like that could have bigger effects, or could be even worse than is assumed, and could lead to bigger changes in real rate. So I think I'm sort of not clear what I think about that, but I do welcome the discussion, which Jean-Marc did not say in his talk, but is in the chapter, that maybe we should, one option is to consider, if we're going to have these low real rates going forward for a long time, whether we would want to deal with, have more inflation to raise the nominal rate and get us away from the zero lower bound. I think that's a discussion very much worth having. So then let me make two final points. One is, there's a lot of discussion about whether one of the factors here is a safe asset shortage, and that's causing money to pile into the US. And I would only point out that most of that money is directed by governments in the form of foreign exchange reserves or sovereign wealth funds, which I'm not sure that the theory of safe assets demand is really what's at work here. These governments who want to perpetuate large trade surpluses. So that may not be the right theory, but that's a small point. Finally, I'd like to comment a little bit about chapter 3. It strikes me that a big part of what Prachi said is the importance of inflation and growth in getting away, dealing with large debts. The most successful consolidations, it seems to me, what your recipe is for easy monetary policy, stimulating growth, and then taking advantage of the higher growth and inflation to consolidate fiscal policy and have a big reduction in the debt to GDP ratio. That seems to be the best outcome. And it seems to be consistent with, again, this idea that maybe raises in inflation do not have to raise nominal interest rates as much. And so real interest rates can fall a bit and help the debt consolidation process. It seems to me we shouldn't just assume that anticipated inflation will always show up one for one in bond yields. Maybe in a very, very long run, yes, but I think it could be many years before that fully works its way through, and would be very helpful to know that for how to go about reducing debt burdens. I'll stop there.
Right. Thank you, Joe. Olivier, your turn.
Thank you. You know, the choice of the chapters is a great one. These are two absolutely central issues. I mean, I'm clearly biased, given that I've spent a large proportion of the last few years working on these issues, but it was really because I thought that they were essential. And then what the IMF can always do, which individual researchers like me cannot, is bring a very large amount of data and human capital to actually dig deeper. So I was very happy to discuss both chapters. So I'm going to comment very briefly on the first, and then focus more on the second. This was a division of labor that we had with Joe. On the future real safe rate, I obviously like the conclusions of the chapter very much, only because they coincide more or less with mine, both in the book that I finished on fiscal policy and then in the debate I had with Larry Summers a few weeks back. It's really very much the same list and the same basic conclusion. If I had to summarize, I would say that the best guess is that interest rates will decrease. They might not decrease back to the large negative values that real rates had just pre-COVID. but they might well stay around zero and therefore be less than the presumably positive potential growth rates. So I think that's the world in which we are likely to be. But then there's a very large caveat, which is that there's a lot of uncertainty about what will actually happen. It's one of the most complicated questions you can think of, the number of balls that you have to think about and keep in the air. So I think there's uncertainty for two reasons. One is that we're trying to find relations between low frequency movements between many variables. And we're not exactly sure what variables to look at. When we look at demographics, there are many demographic variables we can construct. But in general, being able to find a solid relation between low frequency variables in the context of a lot of noise, cyclical noise, is very difficult. So we should be very humble, I think the chapter is, about whether we actually know exactly which factor contributed to what. And the example that Joe gave, which is this parallel paper, which you can't have seen because it's too recent, has the same list, but not quite the same ways. And then I think the other reason is that looking forward, it's very, very difficult to know how all these things are going to evolve, what's going to happen to, how its demographics going to affect saving, and so on and so on. So the bottom line is, yes, we should expect rates to come down quite a bit, but there's surely the possibility that they really go down and we find ourselves in the same position as pre-COVID, which is R less than G, to use the lingo, and the zero lower bound, or the effective lower bound binding. And we have to start thinking about it now. Now is the time, not when it actually happens. And it has a number of implications. And again, I'm going to build on things I've said and written about. But the first one is we can't do much about R minus G. At least it's much easier to do something about the nominal rate by changing target inflation, the point that Joe made. And I think moving from 2 to 3% would be useful. It looks small. 1% more room for monetary policy doesn't look like an enormous amount. But to put it in context, that's roughly what we got from using QE in terms of decreasing the long rates. 1% more, an ability to decrease rates by 1%. So there's a world in which we could probably have had a higher target by 1% and not done QE, and I would feel much better. So it seems to me that thinking about the future, that's relevant. And then the other is, if we find ourselves, say, in the position of Japan, even today, which is what do we do to sustain demand with monetary policy at the effective lower bound? If we keep doing deficits, then that is going to increase. And that's an issue. And at some stage, we have to find ways. And so there is no magic wand, but we have to think about public investment, which has a lot of spillovers, for example. We have to think about where we can decrease precautionary saving. We have to do things which increase demand without making the fiscal situation worse. And this should be, you've done half of the work. So you should definitely do, I'm sorry, I went black for a second, but I'm back on, right? So that's this on the first chapter. On the second, I mean, the chapter really reaches a striking conclusion, which it doesn't put on the front, I suspect, for reasons I can understand, which is fiscal consolidations very often have an adverse effect on output. That's well understood, but also don't have the effect of decreasing the debt GDP, the ratio of debt to GDP. Now, the number, I think, if I'm right, is about 50% of them do not succeed. I understand why this is slightly downplayed in the report, but it is an important fact that we have to think about. So on this chapter, I have to make a methodological remark, which I think affects the interpretation of the results, which is that I think we need to distinguish between what I would call intentional fiscal consolidations and unintentional fiscal consolidations. Fiscal consolidations which come from a burst of inflation which was not expected, or something like this. And we really need to think about the implications of each one. I'm not sure the chapter does a perfect job of separating between intentional fiscal consolidations and unintentional ones. I mean, it takes two approaches, and the first one explicitly doesn't make any difference. Just looks at fiscal consolidations and then looks at the characteristics of the variables. But they could be intentional, they could be unintentional, it could be a burst of inflation. The second one, which tries to do a structural VAR, identified VAR, tries to get at that, but without going into details. I'm not sure that it really does identify what we want. Some of the figures that you showed, Prachi, is just don't seem right. And the notion, for example, that there is a positive correlation between consolidation and inflation doesn't sound right. It sounds more like a reverse causality effect rather than a logical effect from consolidation to inflation. So I'm not sure you've kind of pinned down the effect of intentional consolidations. But this being said, I think that the result that consolidations do not always work is a really important one. And they're actually slightly surprising because when you think about it, you have the initial effect of a consolidation, and that clearly can decrease GDP more than slow down debt. And so it's clear that that can decrease, that can increase the GDP ratio if the effect on GDP is strong. But once you pass that stage and you continue to have the same consolidation, then basically the effect on growth of GDP is now lower, but it's going at the same rate, should basically go away. You should get the effect of the consolidation. So I think in any model I write down, the initial effect might indeed be counterproductive in the sense that you get an increase in the debt to GDP ratio, but over time, the effect of better primary balances should eventually dominate. And you don't find that in the examples that you give. And I find this puzzling and interesting. Again, I would have expected that, yeah, it's better at the beginning, but that eventually it pays off, and that's not what you find. So this is for the intentional consolidations and the table that you showed. Can we learn something from the other consolidations, the ones which come from just an increasing growth or something else? And clearly, increasing growth with structural reforms. I'm lost in my notes, so I want to go back. Sorry about that. Misplaced page. Yeah, so one reason why we get an improvement is that we do the right thing and it's intentional, but it can happen for other reasons, right? It can happen because we have a burst of growth, which makes things better, or we have a burst of inflation, which makes things better. And I think that it's interesting to actually look at those, not that they are particularly, and the first one is desirable, the second one is not, but it's interesting to see how big the effect is relative to the intentional consolidations. And that's something that I would suggest you do. So bottom line, I think the findings reinforce the findings of the earlier 2010, if I'm right, Rio chapter on fiscal consolidations. They're not easy to achieve. To succeed, they have to have the right composition, and I would say they have to be opportunistic. They have to happen in environments in which you can really just use various policies. They have to be implemented at the right speed. They have to be implemented when private demand is strong. or when monetary policy can help, I think that's a very useful, not a new statement, but a very important statement. For stabilization, which, for example, is implied by the EU old fiscal rules, we're now discussing the new ones, may well fail in achieving their goal, and I think that's very important. I had two more remarks which I wrote as you were talking. The first one is when you say we should have an all-out approach. I'm not exactly sure what you mean by that. Is it using inflation? Is it using reforms? Is it just standard deficit adjustment? And then I've left aside the discussion of restructuring, which I think is a really important issue. And there, I think there's really interesting results that you should explore more about whether it's a reduction in cash flow or rescheduling or other things and how they work and how they don't work. I suspect it must have been done by the fund at some other time for some other reason, but that would be very useful to do in that context. But again, I think the main message, which is fiscal consolidations are hard and you should be very careful about doing them, is exactly the right one.
Thank you, Olivier. It is indeed quite striking how the results that face value reductions in debt restructurings are much more effective than other arrangements to lower interest rates or defer payments, and yet it is exactly these face value reductions that creditors so often resist. They want to do anything at all, anything apart from reducing the face value, which will cause them to change their accounts. A number of questions. One relates to this point that you emphasize about the below-the-line operations in fiscal consolidations, and I think it's that you say that fiscal consolidations are undermined very often by below-the-line operations, which could be, as you mentioned, subsidies to public enterprises, which don't enter into the primary deficit, but in fact add to the debt. And the question is whether it would be best to treat these as, in a way, fake consolidations. They're not really reducing the primary debt. They are for the statistician, but in the real world, they're not. That's one question. Maybe I'd add another one that has come in, relates to what Olivier was saying. Clearly, we're not in good times at the moment. So you've said, well, consolidations work when it's good times. And now we're not in good times. And the debt, the uncertainty is high and so forth. Outside of debt restructurings, what recommendations do you make for countries at this point? Should countries be much quicker reducing subsidies, cutting public sector wages, increasing taxes? What recommendations do you make, given that we're not in good times, and it's only in good times that you can rely on this consolidation? Maybe I'll wait. Prachi, you might like to answer those too.
Patrick, how do we go? How should we go about answering the questions? How would you like?
I just thought those two would be enough. If you have a quick answer to those, and then we have a couple more questions on Jean-Marc's.
And quickly to respond to Joe and Olivier as well, or?
Of course, sorry. Yeah.
Thank you so much, Joe and Olivier. This has been really great discussion. Very quickly, I think, let me, couple of points. First on inflation, second on identification, third on all-out approach, and fourth on below-the-line operation. I'll try to go very fast and I'll not do justice to the excellent discussions. On inflation, a couple of things, as Joe correctly pointed out, and Olivier also, that inflation does play a big role in emerging and developing economies. I think we are very clear in the chapters to say that this does not imply that inflation is a desirable tool. That is not an implication of the chapter at all. And because we all know, what the consequences of high inflation can be, especially from point of view of sovereign debt, it can lead to losses on the balance sheets of sovereign debt holders, and and more importantly, dent to credibility. I think both Joe and Olivier probably referred to, theoretically, the impact of inflation depends on whether it's expected or unexpected. And if it's expected, the idea is that, theoretically, nominal interest rates could go up, and that could offset some of the impact on the denominator of debt to GDP. In practice, and let me just point out two things, we still find that nominal interest rates are way low in emerging and developing economies, and that could be either due to concessional financing or due to financial repression in EMs. But we also have a box, which is box 3.2, which shows, and it's in line with Joe's conjecture, that nominal interest rates actually feed very slowly into the effective interest rates on debt. And this could be because, on average, I think the maturities are still very long. So this is on inflation. Very quickly on identification, let me be clear about what we do and what we don't. I think the average impact is, as Olivier correctly highlighted, the average fiscal consolidation has a negligible impact on debt ratios. And this is actually confirmed not only by the simple statistic from the raw data which Olivier quoted, but also from a range of econometric methods. And the range includes a structural VAR, but also a structural and also augmented inverse probability weighting, where we actually use narrative shocks for identification. So we do we do look at based on established methods in the literature. We do take into account what if these are intended narrative shocks in the data. But that said, I think let me say that the goal of this chapter is on debt reduction. And here, when we characterize what conditions, on average, fiscal consolidations have negligible effect, but what are the characteristics of consolidations which actually lead to a reduction in debt ratios? And here we are more, in the spirit of correlation or characterizing the conditions rather than, just going after identification of these effects. Very quickly on an all-out approach, I think Seychelles is a good example where everything worked in the same direction, and which includes timely debt restructuring, but also combined with fiscal consolidation, growth. So it's a combination of things which contributed to public debt reduction in the case of Seychelles. On below the line operations, I think this is what we discovered. If you're looking at the effect of fiscal consolidation on debt to GDP, of course, GDP goes down, consistent with previous evidence from VIO. But the fact is, even the numerator does not go down as you expect. So in many countries, you have these transfers to state-owned enterprises, or contingent liabilities, or clearance of arrears, where you actually in practice are not doing what you say you are doing. Finally, on the conjunctural issue on what should countries do at the current conjuncture. And here, if you look at the forecasted IMF forecasts of output gaps, advanced economies are positive. And EMs, though negative, but they are still increasing. So in the current conjuncture, I think building buffers and fiscal consolidation is one of the implications of the chapter. And I think the chapter, I didn't have time to go into the details, but we also talk about how a debt surge in the past, share of countries with a debt surge has been followed by a wave of restructuring, and we do think that going forward there could be a risk of restructuring, given that the share of countries with a debt surge is very high historically at the current juncture. Let me stop here. Happy to follow up.
Thank you very much. Jean-Marc, just a few minutes for you to respond to the two discussants. And I'd also like you to answer one of the questions that's come in. The simulations of the impact of large green investments, it doesn't seem to boost the natural interest rate an awful lot. And have you got an interpretation for that? Because the questioner thinks that if there's a big amount of green investments, that should bring interest rates up.
Yes, thank you, Patrick. Many thanks to Olivier and Joe for their discussion and their comments. I see time is pretty limited, so I'll be very short in answering their main point. Clearly, uncertainty is part of the exercise that we're conducting, and uncertainty is particularly large for the future. So we are aware of that, and what the strategy of the chapter is to try to look at different ways of getting at the level of interest rates, and we are kind of reassured that the filtering methods and the calibrated model led to a similar pattern for the natural rate at the headline level. So, but clearly, this is the main issues that we confront and the rest of the literature on the topic. One thing that I would like to point out is of course, the calibration of the models do matter, and there could be some differences. So there, I would like to point out also to the online annex that will be published. So we are very transparent about our calibration, and then can be compared to the paper that you mentioned, Joe. I didn't know about it. So bottom line is that yes, calibration is indeed important, but we don't have much of an alternative to try to get a sense of what the natural rate will be or could be in the future than to look at a structural model and to simulate assumption based on the fundamental drivers, and that's what we are trying to do. So by being transparent and trying to simulate the alternative scenario, we hope that we can at least bring some light to the topic. I think I'll stop that there for the discussion, thanking them again. On your question regarding the green transition, I think one point that maybe wasn't clear enough in the presentation is that the impact on the natural rate that we show in this chart is based on the assumption that the transition is fully financed. So there is no debt incurred in doing this. So basically, having higher energy costs would bring down per se the marginal productive capital and bring down investment. So that's the main mechanism that's behind the decline in interest rates. We also simulate more ambitious programs that are financed by budget deficit. And in this case, yes, then you get more investment, and then you get a higher interest rate, at least temporarily, until budget is again balanced.
Thanks very much. That's very helpful. That's very clear. And as you say, there's not only the whole papers to read, but background annexes and papers that are cited in the list of references. So this is a real cornucopia for people interested in these topics, of whom there are many. Thank you very much. We're out of time. Thank you, Prachi. Thank you, Jean-Marc. Thank you, Olivier and Joe. And thank you to all participants watching in.
Thank you, Patrick, and thanks, Joe and Olivier. Thanks a lot.
Thank you very much to all. Thank you.